Hello, this is Edward Lambert at the Effective Demand Research. And this is going to be a quick video, I hope it's a quick video, about how raising interest rates can affect real GDP. So we start out with the money market, where you have demand for money, the supply of money, and where they meet sets an equilibrium interest rate. Now the supply of money is basically determined by the Federal Reserve, and the demand for money is a function of a certain nominal GDP. So the demand for money is really transactional demand. You need enough money to meet the prices and the output of the real GDP. Now, real GDP can be broken up into labor share and capital share, and these two percentages add up to 1. You multiply 1 to the GDP and it doesn't change. But you can actually factor out labor share to real GDP and capital share to real GDP and get two separate versions of the money market. And that's what I did in the previous video. Here's a recap in that you have the money market for labor income and the money market for capital income. And you start out with a certain supply of money in the labor income money market, which is basically determined by wages, salaries, income. And then you have the supply of money in the capital market, which in many senses it's determined by the Federal Reserve. How much money is made available to the capital market for investment and business. But then the amount of money that's given to labor is not determined by the Federal Reserve, it's determined by business. And so business determines that labor share fell 5% since the crisis. So as you have a relative decrease in the supply of money to labor, and that changes the equilibrium interest rate to a higher interest rate. But as capital share increased since the crisis, the supply of money to capital has increased, and so that lowered the equilibrium interest rate. Now, capital market determines the bond market, which determines the interest rates. So the interest rate fell. See if I can get that right on line there. So the interest rate fell to that lower interest rate, to the equilibrium interest rate in the capital market. And what happened was, I explained in the last video, is that real GDP had to fall so that the demand for money and the supply of money after the crisis made GDP fall to an equilibrium for the money market of labor income, right here. So then that implies, so what if you raised the interest rate? Because right now the interest rate, the low interest rate, is good for the capital market, puts that into equilibrium, and they can borrow money cheaply and try to invest. But you have this labor market here, which is in trouble. And usually after a recession, labor share of income will start to rise, and the supply of money here will start to increase again. And that will, as the supply of money to labor increases, you get more purchases in real GDP, and real GDP will grow. But in this case, right now, labor share is still falling, and it's at its lowest point. So the supply of money to labor is not changing. Now, here's the thought, is that if the Fed was to start raising interest rates, I'm just going to take it up, you'll see now that in the labor market, the supply of money is greater than the demand of money. So what does that mean? That means labor has more money? Well, relative to their demand at that interest rate. So since labor has more money, usually they would go ahead and buy bonds, and that would raise the price of bonds, which would lower the interest rate back down here. But the Fed can maintain that higher interest rate higher. So what does labor do with that money? Well, they can buy goods. And this is the idea, is that at this interest rate, this higher interest rate, there is an implicit process, an implicit mechanism to do something with that extra money. And if you don't buy bonds, and if you have to maintain that certain interest rate, the idea is that the money will be spent on goods, and GDP, through a process, will slowly begin to rise to eventually reach this equilibrium. Just as GDP had to fall to that lower interest rate to maintain equilibrium, GDP will be coaxed up into this higher interest rate in order to maintain equilibrium in the money market for labor. But now what happens in the capital market? Now, the capital market already has a lot of money, and we've got to be careful that they don't have too much money where they start speculating and creating all kinds of bubbles. So they need somewhat of a control. A lot of concern about the bubbles. And so in this market, they too have an oversupply of money to the demand for money. So what would they do? Would they go ahead and start purchasing bonds to try and lower that interest rate back down to here? Well, they can't. The Fed is maintaining that higher interest rate. So what does business do with this extra supply of income? Well, they can just keep trying to purchase. They can keep purchasing and purchasing and purchasing and purchasing and purchasing bonds to try and drive that interest rate down, but the Fed is battling that. The Fed is saying, no, we're not going to allow that interest rate to go back down. We're going to maintain the interest rate up here. But then business, the capitalists, they begin to look over here and they see that labor income somehow is purchasing more goods and services. That real GDP is rising, so they think, well, business is rising, so maybe we should just invest. So instead of buying bonds, you could have the capitalists move their investment to an equilibrium up here. So now that you have this supply of money, which the Fed is giving to them, you have this supply of money, this huge supply of money that the Fed is creating on their balance sheet. And now business will invest it because, not because of the higher interest rate, but because they see that labor is buying more goods and services. This creates a weird type of situation for the LM curve in the ISLM model. I'm not going to go to the ISLM model because I want to keep this video somewhat short. But this is the basic idea, is that as the interest rates come up, there's a process, a coaxing, that there's this implicit supply of money. And that in order to bring this market back into equilibrium, and since the supply of money won't change, and since the interest rate won't change, you're either going to have to raise prices or you're going to have to raise real GDP.